morning, everyone. Thank you for joining us. I'm really honored to have this session with Ted, who's a friend and a colleague and someone I've had the honor of knowing for 20 years. I believe Ted is really doing a lot for our industry in terms of democratizing access, ideas, and really spreading the knowledge of the great leaders and thinkers in our industry through his podcast, which today is the most prominent podcast in our industry. Ted, thank you for doing this. A little while ago, you said you'll never write a book again, and you've just written your third book, Private Equity Deals. Tell me how you heard about private equity and when you first learn't about it.
So I came out of business school in 1999. I'd heard about private equity when I worked at Yale, but I didn't do much with it. Excuse me. So I came out of business school in 99, and I went to work with a firm called Stonebridge Partners, which is one of Yale's managers. And there were three partners, a guy named Harrison, who had worked with Dave Swenson at Lehman Brothers, Bob, and Mike. I got in the office the first day, and Harrison was there, and he starts talking to me about what we're going to do and how deals work. And I was like, okay. And then I didn't see Bob or Mike for that week, and they were traveling. And then the next week, Harrison wasn't there, but Mike was there, and he started talking to me about deals. And then the next week, Bob was there, but Harrison and Mike weren't. And it took me 6 weeks to realize that the three guys hated each other. So my first experience in private equity was working for this boutique place that Yale was the lead investor in. And I was super excited to get there and learn the business and think this is going to be a rocket ship. And I learned, wow, even Yale had no idea what was going on. That was my first experience in private equity.
Wow. And how do you think private equity has evolved since your first interaction back then to where it is today?
Well, that firm's not around anymore.
Okay.
It's changed a lot. So in the last 25 years, you've had mass adoption. I don't have to tell anybody about that. There were some things I saw back then that are part of what needed improvement and has had happened. So for example, Stonebridge co-invested in all their deals. What I didn't realize is what they did was they would take their quarterly management fee, turn it around, and put it in the deal. They actually weren't aligned at all. They were investing other people's money. And that happened for years, but it doesn't happen as much anymore. So you've had this industry that has exploded with really great success for the LPs.
Why do you think it's exploded? I mean, if you go back to the 80s when David Swenson started investing in private equity and you look at the industry today, do you think you can get the sort of returns and opportunities you had back then, or is there just too much money in the industry today?
Well, those are two different questions.
Yeah.
So let me start with the first question. It exploded in the same way hedge funds exploded after 2000, which is you had some turbulence in the markets, and this newer area did well. And people have to meet spending objectives. And so that happened with hedge funds then. It happened with private equity in and around the financial crisis. Since the financial crisis, we all look back now and say, wow, index funds have done really well. 60-40 was such a success. This has been the greatest bull market that nobody believed in. I mean, going back to 2009, 2010, people thought stocks were overvalued, bonds gave you nothing. So you've had this long period of time where, for the right reasons, institutions looked at how else could you invest your capital beyond just stocks and bonds, and then stocks and bonds and hedge funds. And there was activity in private equity, but through that period of time, because you didn't have really a calamitous depression, the businesses private equity held through clever operations, through clever financial engineering, made it through. And then you had through cycle returns that looked really good. So more and more you started seeing that adoption. And that's, now we're talking about the last 15, 20 years, and it's really exploded.
Why do you think people are so in love with private equity today? Do you think it's because they hated hedge funds and they moved into private equity? What's your thoughts on that?
Depends which people you talk to.
Okay, true.
In the public domain, it's all negative.
Yeah.
And a lot of that is, and this again goes back to hedge funds, because of really the SEC's regulatory regime until the last couple of years, as a private partnership, you couldn't talk publicly. So anything you saw in public was sensational. And venture capital has sensational outcomes, but private equity really doesn't. They're good, but you tend not to have these newsworthy events. So the only newsworthy events you got are the disasters, and there are plenty of them. In the industry, There's a couple reasons why. The first is, by and large, it's worked. The private equity returns have delivered on expectations, and when that's happening, and people still don't believe that the public markets will deliver or that bonds will deliver, you just get more and more interest. The other piece, of course, is when David Swensen started adopting private equity, he looked at illiquidity and said, we can get an illiquidity premium, like the businesses we're buying are cheaper. Illiquidity has strangely become a feature more than a bug. Because if you can lock up your money for 10 years, it's one decision, your board can't get in the way, there's a wobble in the economy, you're stuck in the assets, and it becomes this great form of compounding capital because people can't get in the way. So you put those things together, and it's been a very, very attractive place. Now, you've also had this incredible backdrop of macroeconomic environment, right? Up until recently, you've had rates going straight down, you've had valuations steadily ascending, and so all of the levers at the disposal of a private equity manager have been there for the taking.
What do you think the delta should be on the return expectations between privates and publics, especially when you think about that illiquidity premium?
Yeah, I mean, it should be higher. I think most institutions look at 300 or 400 basis point outperformance, and that's gotten competed down. Valuations are a tough argument. People look at valuations and say, well, valuations of private equity are higher, and that's true. But valuations of public stocks are higher also. So what else are you going to do? But that's probably still right. I mean, I think people need the return premium to accept that illiquidity. You're trusting people for a long period of time, for the most part, certainly in a fund investment. And so I don't know how you underwrite to 400 basis points versus 250 basis points. If you think you're getting a return premium, you're going to invest. If you don't, you won't.
What do you think about the haters of private equity who say they gut businesses, they lever them up, and they just sell them at the highest price they can to the public markets?
So last year, part of the reason I decided to do this book is there were two books that came out with the word plunder in the title, and they were both from journalists. The problem is private equity is everywhere. It canvasses the global economy, and there's, say, 10,000 businesses. You have everything, right? You have really a lot of successes. You have some really bad failures. You have mostly, I think, good actors. You have some bad actors. And the idea of picking out a couple of companies that went bad, which is what these books have done, and particularly in certain areas of the healthcare space, where they say, oh, because a private equity firm invested in this company, it was doing well, they took out a dividend, something happened to the business or the economy, the business went bad, therefore all private equity is bad. It's just a ridiculous argument. None of it is based on any data. It's all just a couple of anecdotes. And those are those sensationalized stories I alluded to earlier. So yeah, there are going to be some problems, and that's always going to happen.
So we see private equity is mainly a US phenomenon. How do you think about it in other regions of the world? Do you think it's workable, or it has to be structured differently, thought about differently, governance, those sorts of things?
There are reasons why it's predominantly in the US. I mean, the first is you've had the accessibility of capital for a long time. So not just equity capital, which is true and more prevalent in the US, but all the financing markets. So you've had debt, you've had the risk-taking appetite, and then you have the regulatory regime. So I think private equity will remain predominantly a US activity, but you have seen it more and more around the world.
Interesting. And when you break down private equity into different subclasses, how do you think people should think about, say, growth equity versus buyout, real estate? You know, help us sort of understand how you think about that and how we should think about it.
Yeah, it's all a spectrum of risk and reward, right? So venture capital, riskiest, earlier stage, you get into growth equity. Buyouts are generally leveraged buyouts, so they're not as leveraged as they used to be, as later stage. Real estate's kind of on the side, the hybrid of equity and debt and infrastructure. When I wrote about the book, I wrote about, call it that later stage, private equity established businesses, mostly because there's plenty of venture capital information out there. And I think generally, even the public, because of the wildly successful outcomes of a Facebook or a Google, has a positive disposition towards venture capital. It's probably not as justified as people believe. And private equity, which is much, much larger, right, trillions of dollars, isn't well known in the public and has generally a negative view But that's the spectrum.
What do you think people get wrong when they allocate to privates? What is the one thing they're missing?
There's a lot of places where people trip up. I mean, usually it's performance chasing across everything. So where you see mistakes, it's perceived brands where there's some turmoil inside the organization, a little bit like I described at Stonebridge, and people aren't doing the work to realize that the next fund isn't going to be as successful as the past ones because of the people involved.
When we look at privates today, particularly a lot of the LPs that you and I know, they're not getting money back, they're stuck in illiquid positions, they don't know the value of their investments. What do you think will happen when those firms start returning capital back to those organizations? Do you think it'll go back to privates or?
Well, the way asset allocation works, I think it's interesting that the private equity firms think that that capital will be recycled within private equity. But we know that's not the case, right? The first wave, because you've had money drawn out of the more liquid asset classes to fund that sort of bottleneck in private equity, the money first will get pushed back into more liquid markets until you get to a normalized asset allocation. And then what happens with the growth of the industry from here is it's always a question of supply and demand for capital on the margin. So today, a lot of the established players, you think endowments, foundations, certain pension funds that have been in the space for a long time, they have their allocations and they're a little bit high or higher than they'd like. It's going to take a long time for those to come down. But what you are seeing is that, maybe not mass affluent, but the private wealth asset allocation shift, some of the newer sovereigns that are growing their private pools, those are big dollars, and they'll come into private equity. But for the capital, for those people who have mature portfolios that are in the space waiting for distributions, that money will not get recycled in private equity probably for another 3 to 5 years.
We talk about democratization of private equity, particularly access from RIAs, private wealth. Do you think it's a ticking time bomb, or is it something the industry needs to get more assets into the asset class?
I don't know. There are good use cases for private equity in a lot of these portfolios, but there are also kind of over-exuberant use cases. So I'll give you an example. If you're talking about the ultra-high net worth, which is probably already there, multi-generational wealth is fine. A lot of the democratization talks about the mass affluent. And so if you think about someone who doesn't have multi-generational wealth, but does have wealth, that they've earned their money through their career, and maybe when they're in their 50s and 60s, they're ready to deploy capital, I don't think they're going to want to lock up a lot of their money for 15 years. I think about it as I don't want to leave my kids' partnership interests in private equity firms. Like, it's just not enough money to do that. So I'm a little skeptical that this mass wave continues for a long time on the private wealth side. And the other big pool of assets, of course, is insurance. We've seen this huge move in private credit. And as a lot of these insurance pools get merged into private equity firms, for now it's private credit assets and private credit, but you could see some small piece of that turning into private equity as well and being another growth engine for the industry.
Great. Over time, do you think certain industries attract private structures and work better for private structures than other industries? So like biotech, for example, technology.
Probably. I mean, I would think it's shorter duration. So it wouldn't be biotech, but certain tech trends. So there are certain sectors that you could say work because the cycle will work out quicker. You also have to think about the structure on the other side. So what's happened with this private wealth is you're taking an illiquid asset and you're trying to put it in these interval funds, a more liquid vehicle. And it works well with a cash flowing asset like private credit. It won't for private equity. It's just really hard to see how that works in something that typically has a drawdown structure and then has long duration.
So when you wrote this book, what is the most interesting thing you learned about private equity that you didn't know before?
I think the biggest thing is that what used to be leveraged buyouts aren't that leveraged anymore. So you think about the capital structure of one of these deals, and banks lend based on cash flow. So if a bank is willing to lend 6 or 7 times EBITDA to a deal, that hasn't changed that much as valuations went from 10 to 12 to 14 to 16 times for private equity deals. So what has ended up happening is the private equity firms have put more and more equity in, And yes, they're levered, but they're not nearly as levered as the old days. So that was a big kind of eye-opening thing for me because I just hadn't thought about that math.
And if you were becoming CIO of a pool of capital today, which private equity firms would you put in your portfolio?
It's easier for me to ask the firm. So I tend to like mid-market firms, and how I have some money with One Rock Capital and a little fund called Permanent Equity that does micro buyouts. So there's a host of them. Arctos I love.
And do you think we're going to see a growth in private equity continuous, or we're going to have a shift back to public markets over time? People are going to give up on privates.
I mean, private equity is a better way to compound capital. And it is really hard to see how you're going to have, for example, a wave of IPOs out of the private markets, because as long as there's capital to fund businesses privately, these CEOs do not want to be public companies. And maybe in the next 4 years, Republican Trump administration, some of the regulation gets softened, but there's so much conceptually embedded in the regulatory regime about protecting people from public market investments. It's hard to see how that's going to be like a good outcome. So I think you'll see more growth on the private side than the public side, even from here.
Do you agree with what David Sensen said, that private equity is a far superior form of capitalism?
It's a far better way to compound capital over time. If only because you just get all of us idiots out of the way from making mistakes.
You think over time more public companies will delist and go private? We've seen a shift in it.
So yeah, I mean, like in my early days at Yale, I used to do analysis on the Wilshire 5000, and there were 6,500 companies, and now it's 3,000. But I think what people don't talk about is I think 800 of them are biotech companies, and there's really not a lot left. So yeah, you'll continue to have public to privates. I don't know if we'll see it the other way around, the way we almost did in the wave of SPACs a couple of years ago.
Yeah.
But somehow there'll be a shift. I can't tell you how that's going to happen. But usually in all investing in all markets, when the boat tips too far on one side, markets find ways to sort of right the ship. So I don't know how that will happen, but I do think somehow we're going to see a change and there will be more public companies.
So for those of institutions investing in private funds, what's the 3 or 4 things you think they need to pay attention to when they're considering investing in a private manager?
Yeah. Well, the most important from here going forward is the ability of the private equity firm to make operational improvements. Because it doesn't look like you're going to have tailwinds from rates and the ability to do anything creative on the financial side. And it doesn't look like you're going to have multiple expansion, which means the only lever left is operational improvements. And just from talking to a bunch of people, the common knowledge is only about 1/3 of private equity firms actually move the needle on operations. So we may well see a shakeout, but that is the one lever that people have to be very careful in focusing on when they're making new commitments.
When you think about opportunities today in the different segments of private equity, where would you put your own money first?
I've always liked the smaller, nichier stuff. I mean, that's just my entire career is that. I do think that you've got 2 completely different markets with the large-scale mega buyouts and then everybody else. And there are plenty of opportunities in the mid-market. Again, very focused on the firms that can drive operational change and make their money from improving the operations of a business, because I don't think there's any other way that you can count on generating returns in that space.
Interesting. Where would you put your money if you were looking at opportunities in Asia today? Are there any particular markets you think there's private opportunities? India, Japan, China?
Those are, I wouldn't say China. Just
okay.
Not for me. Japan looks particularly interesting. I'm not sure if the best opportunities are in the public markets or the private markets, but you have what looks like real meaningful change. There have been pump fakes for the last 25 years about this.
Yeah.
But now you have corporate governance coming from the government on down and not from 1 or 2 US activists thinking they're going to rattle feathers from the bottom up. So we've had some move in Japan. I think there's a long way to go in that market in particular.
So let's talk about all the things you're doing with capital allocators beyond the book. You tell everyone what we're up to and what's kind of exciting you at the moment.
So the podcast keeps rolling, and then alongside that, Rahul and I have partnered up on a whole bunch of stuff. The newest initiative, which is coming next month, is we created this course called Capital Allocators University during COVID. And it was really a bunch of disciplines to teach allocators skills that are taught in every business except for investing. So think about interviewing techniques, leadership, management, negotiations, time management, things like that. We've now developed a curriculum for investor relations and business development professionals. So we're both going to teach a class. I'm going to teach something from the allocators' perspective, Rahul from the managers. We've got some friends of ours teaching about branding and managing conferences, and a panel of CIOs to tell people what not to do. And then we layer that in with peer networking. So that's the first week of December in New York. But that's the newest thing we've got our eye on.
When we think about the podcast and going forward there, I think you don't realize how many people use the guests and the information and the knowledge they share to really, really make an impact on building teams, building cultures, investing in portfolios. Who would be someone who's not around anymore that you wish you could have had on the podcast?
Or you just teeing me up to say Dave Swenson? I mean, that's
no, you can say anyone you want.
Not that I didn't ask him to do it.
Charlie Munger.
No, it's a funny thing because I get asked a bunch about what guest I would most want to have on or haven't had on. And the way I think about the show, it's not that typical, oh, there's this celebrity investor or somebody like that. My favorite thing to find is a manager or a CIO that I don't know, who someone, really more than one person, tells me that person is so exceptional you should have them on the show. And I've found a few of those through our summits, which is another thing, sort of an invitation-only, very boutique-y events that we put on. But those are my favorites. My favorites are the next person. So I can't name who it is because I don't know them yet. It's that next person that has a differentiated insight, is really exceptional at what they do, and generally are off the radar. Those are my favorite ones to have on the show.
When we talk about the summits, can we share a little bit about what we do and how they're unique?
Yeah, so most of how I spent my time, I do this podcast and each one maybe takes a day or a little less than a day a week. And then I would be on calls all afternoon with what I've always done, talking to managers, talking to investors. And I started to realize it was an incredibly inefficient way to spend my time. So there was always convening power under the summits, and people coming out of COVID talking about wanting to connect with each other. But most of the time people come to conferences and they have to sit and listen to Rahul and I talk for a half hour. You're not actually connecting with each other when you're doing that. Not that, Rahul's not good looking and stuff. But, so we had this idea of bringing people together where there is no stage. Right? There are no panels. There are no speeches. There are no one-on-one meetings. It's all of this that happens here has a great use case for investing. It's just very different from how I enjoyed spending my time. So we do that, and we bring in about 120 people at each one. It's generally 80 investors, 40 managers. And we meet for 2 days in a series of small group discussions about topics that are generated from the people who are coming. And it's been fantastic.
It has, really. Ted, thank you very much. Thank you all for listening. Really appreciate it.
Thanks, buddy.
Thanks.